basically what it builds is like this, is that you put in your initial investment, and then it creates a cash flow, a monthly cash flow that's coming off of that over the next 7 years. It's a little bit different than what we normally think of because you don't have an asset at the end.
Whenever we're setting up or utilizing cash value life insurance, regardless of whether it's whole life or IUL, and we do utilize both depending on the situation, depending on the strategy, but regardless of the situation, they should be max funded for cash.
Welcome to Passive Income Pilots, where pilots upgrade their money. This is the definitive source for personal finance and investment tactics for aviators. We interview world-renowned experts and share these lessons with the flying community. So if you're ready for practical knowledge and insights, let's roll.
Hey everyone, welcome back to Passive Income Pilots. I'm your host, Tait and Ryan, here solo today. I'm in a rental studio in Reno, Nevada, as I scramble to get this short-term rental up and ready before the end of the year. Ryan's out on a road trip with his family, so I'm hosting the show solo today. Just had a wonderful interview with Rod and Christian from Money Insights Group. I think everybody's going to take a ton away from it, so enjoy the show. Christian and Rod, thank you so much for joining us.
Thank you.
Tait, thanks for having us, man. Like I said, I've been listening to your stuff, and you guys do a really great job. Thanks for having us.
Absolutely. It's nice to connect. And so let's get started with how you got into the business. And, can you outline, why did you gravitate from the traditional space into the alternatives? What's your background?
Yeah, I'm happy to hit on both of those. So my experience coming into the financial services industry was 20 years ago. And the catalyst for it was just a really bad experience that my own mom had. So my dad passed away when he was just 49. And so my mom was kind of left in this, difficult situation where she had to figure out how to kind of do the finances, where she hadn't previously been in that situation. Sadly, she was taken advantage of by people she really should have been able to trust, kind of your typical financial advisor that just was focused more on themselves and, making money than they were focused on my mom. That was like the catalyst for me kind of getting into the business. And I just kind of wanted to come in and do a better job. When I got into the business, I kind of went down down the traditional path, at least initially. Over time, the way that we ended up kind of gravitating to the alternative space is just because we were seeing proof that the traditional things weren't working. Like we weren't seeing consistent evidence that they were producing results. While on the other hand, when we were seeing people who were being more successful financially, it was almost without fail, they were investing in alternative assets, things like real estate and cash flow producing things. And it was just a different mindset. And so for us, 10 years ago or so, we really shifted that focus and started kind of gravitating to how to help people build their wealth, specifically in the alternative investment space.
Excellent. And Rod, what about you?
Yeah, so my journey kind of in this world began when I was in college. And I came across this book, Rich Dad, Poor Dad by Robert Kiyosaki. And so from a young age, I had this vision of becoming my own business owner, investing in, a variety of different things. And so that kind of, the journey brought me, once Christian and I are kind of paths crossed about 14 years ago. And from there, we started working together and kind of bringing the pieces to what we do now. And the interesting thing about that is that it basically just comes from this desire that I have to be investing in the alternative space, in myself, in my business, those types of things. And now with the kinds of things that we're out there doing for people is just teaching them how to do the same thing. We see people who kind of see the light in terms of, again, not getting what they want out of the traditional side, and wanting to do more in the alternative space, and they just don't know how to get started. So that's kind of where we built our business around, helping people to do that.
When you said that, Christian, we were chatting before the show, and you were saying that you initially were doing more traditional registered investment advisor stuff where you're placing people's money in stocks, bonds, mutual funds. Can you give some context and background of what that journey was like, and then what it was like once you got there, and why you wanted to make the jump over the fence?
Yeah, I would say kind of going back to my how I got here story, it became really obvious just by meeting and working with people, right? Like the proof was right in front of me. And at that time, like I remember early on in the business, you're just like happy to get in front of anybody you can. But again, the thing that I kept noticing is that when I was getting in front of really successful people, there was just some things that didn't line up. The things that I was teaching, that I was being taught, just like weren't being practiced, right? It wasn't all about maxing out 401ks. Not that I'm saying that's never a good idea. It oftentimes can be. But it just wasn't all about trying to save as much money in retirement accounts and then hoping that the market did the rest. Like that wasn't producing results. And so it became one of those like hit you in the head moments where I was like, oh, well, when I take these people and then I take these people, like it just became really obvious, if that makes sense. So
it makes total sense.
We kind of made this, like we just made this shift and we came up with like a philosophical framework that we teach people so that they can kind of get on that same track. And we call it the invest with benefits philosophy. And really the philosophy is like geared around optimizing every dollar that we get into our financial world. And it basically focuses on optimizing in 6 kind of key focused areas: leverage, velocity, cash flow, asset protection, estate maximization, tax optimization. So that's kind of our framework that we teach people. And again, this journey was really started with like that know your number philosophy, right? We kind of all remember the know your number IRA thing. And it just was like a step-by-step change in philosophy. And again, it really came back to what was working for the people that I was seeing. And then I would say Rod and I were also really fortunate to create some really significant connections in the alternative space and in the high income earner space. And that just like propelled it to the next level, because now we were meeting exclusively with high income earners, and this like gap between what was working and what wasn't working just kept getting bigger and bigger. So anyway.
Right. Yeah, it makes total sense. So a lot to unpack there. So I want to kind of back up to when Christian, you and Rod, you two met and what the chemistry there was, and talk a little bit about your company and your platform. And then let's go through those 6.
Yeah, Rod, why don't you take that one?
What were they called?
6 core benefits.
6 core benefits. That's it.
Yes. Yeah. So when Christian and I first started working together, it was in the life insurance world. So Christian had this kind of awakening and was in the process of moving away from the traditional space. And he actually recruited me to be on his team. He was kind of building a team. And over the next few years, we became more and more integrated. The stuff we were doing, we just were doing more and more together. And it got to the point where instead of just working out of our local office, we started working with people across the country. And that's when we formed Money Insights. That's when we really caught the vision of being out there and educating people on these kind of core principles that we're going to talk about here in a minute. And over the last 10 years, we've just kind of developed it to the point where now it's this cohesive philosophy and approach where we can plug people in. And it's not a one size fits all. It's still very much customized to the individual and what they want to be investing in, what they're doing in their world, but building the structure and the framework around that to just make it better.
So once you formed Money Insights, how did you boil these concepts down into the 6 core benefits?
Yeah, it's a great question. So initially we were maybe a little more strategy focused. And one of our strategies, we call it the investment optimizer, is where we're taking people who are investing in alternative assets and making the cash flow more efficient as they're moving it in and out of their deals. But when we would meet up with people, they're like, oh yeah, I love this. I want to do this. They would set up the plan. And then they would say, okay, great. Now what do I go and invest in? And we're like, I don't know. Like this was supposed to be you. And basically what happened is over the last 10 years is we've realized that people may want to invest in alternative assets and have that desire, have that like building that knowledge base, but not know how to get started, not know where to turn, who to connect with. And so over that time, what we've done is built around us. We have our core competencies, And then we're teaming up with, we have links to a whole bunch of other people in the space so that we can connect investors with the investment opportunities that they want to be involved with.
So you said something there. You said make the cash flow more efficient.
Yeah.
And then you said once we set up the plan. So can you break down those two things? What does that actually mean?
Sure. Yeah. So our investment optimizer strategy is basically where most people we meet up with are, when they invest in real estate or their business or whatever, they're running that money through a savings account or maybe like a money market account. And the reason they do that is because they want the safety and the liquidity, right? Money's sitting there ready to go when they get the opportunity. Challenge is it's not very efficient while it's there. And what I mean by that is it's not growing much, and it's just a one-way, like in and out kind of flow. With the investment optimizer, what we're doing is we're setting up a specialized life insurance policy that is optimized to growing the cash value, so that in addition to the safety and liquidity, we're able to create some consistent, predictable growth on top of that. So think like 5+% tax-free return. And then when we're using that money, we're not actually taking our money out of the plan and using it to go out and invest. We take a loan against it. So the flow actually looks the same as when people are running it through their savings account. But in this case, what happens is I take that money investing it somewhere, but because I took it as a loan, I have that loaned money out working for me in the investment. But now I have my underlying cash that was in the account. It stayed there and continues to grow as well. So we're literally creating value in the same place, or in multiple places at the same time with those same dollars. And so as I'm flowing that money back, again, same thing. I create cash flow, I flow it back, I build that back up, go out and invest in something else. But all the while, I have this additional layer of profitability in addition to the returns that I'm creating in whatever else I'm investing in.
To like decode some of what Rod said there at the end, when we say add a layer of profitability, we're just saying instead of producing, let's just say we're producing 12 or 15% on our real estate deal, we can bump that to 17 or 18 just by flowing it through the policy first, creating that additional layer. That's what he's meaning. So it's literally more money over time. It's one of those things that when you see it played out over 20 years, it kind of becomes like a no-brainer. So that's kind of why it's one of the core strategies that we use amongst a couple others that we'll probably hit on.
Yeah, got it. So let's touch on the 6 core benefits. But before we do, since we're on the subject of life insurance, and it seems like that's sort of the center of what the strategy sort of revolves around. Yeah, let's touch on that, because we've talked about it on the show before, but it's an incredibly complex and sometimes difficult concept to wrap your head around. So are we talking about whole life or universal life? We're obviously not talking about term. Maybe you could break down the 3 of those, and then which one you guys use and why.
Sure. So yeah, you're right. We're not using term because term insurance is really basic. I pay my premium. If I die during the 10 or 20 year term, then insurance company pays out death benefit to my family. If I don't die, which is what we're all hoping for, then I just paid that premium and we move on.
It's like car insurance.
Yeah. Very, very basic insurance.
You rent it. Yeah.
Yep, exactly. In what we call the other category, cash value life insurance or permanent life insurance, inside of the policy, we're building a cash value. And the original intent of the cash value is so that I can have that insurance last the rest of my life, no matter how long I live. But as I'm getting older and the costs are getting higher, I have this nest egg of cash that's in there that's helping offset those later costs. So that's kind of where it began. And what's happened is it's just evolved into a place where we can use it as this kind of like supercharged savings account because, number one, the IRS gives special tax benefits for life insurance, for cash value inside of life insurance policy, meaning the money I put in is after tax, and then it grows tax deferred. I'm not getting a 1099 at the end of each year as I go, and then I can take it out and use it tax free. So think of it like a Roth from a tax standpoint, kind of like we think of a Roth. So we often get that question, well, man, why life insurance, right? And the answer is that there are specific benefits or specific attributes that come with a life insurance policy that work to our advantage in these specific ways as we're flowing the money in and out of our investments. And we just can't get those things anywhere else.
So can I compare real quick to, let's say, a stock account outside of a retirement account? So if I open up a brokerage account with, say, Merrill, and I've got $500,000 in there, I can borrow from that as well and not actually liquidate the stock. So what are the differences between borrowing from a life insurance policy versus borrowing from, or borrowing against, I should say, a stock account like that?
Yeah, I would say there are a couple of big differences. The biggest difference is the amount that you can get as a part of the asset. So in other words, let's say it's $100,000 sitting in the brokerage account. In most cases, you can get up to about 50% of that as that loan. You have the same $100,000 sitting in this kind of whole life insurance policy. I can get up to 95% of that value. So right off the bat, it's a lot more value, a lot more money that you can be using to going out and invest. And then secondly, the reason why there's that big discrepancy in the amount I can get is just because of the risk of the asset. These whole life policies are very consistent. There are a lot of guarantees in terms of the growth of the policy of what as the cash value is growing. And so I can be going out and investing in whatever I want, knowing that my underlying account is not going anywhere. It's going to just continue to grow and compound at a very consistent rate. I don't have to worry about that. I can be focusing my attention and maybe more of my kind of risk out there in other places.
And you wouldn't have to worry about a margin call, right? For someone
Right.
that doesn't know, if you go out and you borrow 50% of your brokerage account value and the stock price collapses by 50%, your broker is going to call you and say, hey, you need to fund your account with, $250K to get back in line with that 50% sort of loan to value ratio, right?
Yep.
So does that exist in the life insurance world, or is that not something that could ever happen?
Yeah, it's just not something that you would run into here. Again, because of that, the guaranteed growth that's happening in the background. And so I just don't have to worry about that.
I've said this on the show before, but about 7 years ago, I set up a life insurance policy, but it was structured incorrectly. I walked away from about 30 grand. So very, very important that these policies are structured correctly, because
Critical even.
yeah, absolutely critical. The way that mine was structured, I couldn't access the cash for nearly 15 years. And there was a great benefit when I retired, but the whole reason I wanted it set up was so that I could invest in real estate and have access to working capital throughout the years that I want to be investing. So I had two choices: either walk away from the $30,000 that I'd already put into it, or continue funding it for the next 15, 25 years. And I just said, you know what, I'm going to walk away. So don't make my mistake.
Yeah, those are hard conversations, man.
Yeah, you got to go to a firm that knows what your goals are. Just to be clear, this was set up through a more traditional wealth management firm that I was working with, long before I had, a more robust network of people who understood the alternative investment space. And so while I was out there investing in real estate and investing in all sorts of my own deals, they didn't understand that. So in any case, Christian, go ahead.
Yeah, and that's huge. That is hugely problematic. I was just going to say, from our perspective, from a philosophical perspective, whenever we're setting up or utilizing cash value life insurance, regardless of whether it's whole life or IUL, and we do utilize both depending on the situation, depending on the strategy, but regardless of the situation, they should be max funded for cash, right? Which just means that we're minimizing cost or maximizing cash. And some people will say, well, if your goal is to create higher death benefit, then maybe that's not the most efficient way to do it. But I would argue that there's much better ways to create the death benefit than to water down the way that your policies are built. So from our perspective, what we would do is we would max fund the policy so that it's, again, minimized for cash. That'll bring the death benefit down. And if there is a death benefit need, we'll cover that temporary need for term while the cash and
Right.
death benefit builds up and grows to that point. But my point is just to emphasize, that sucks what happened to you. And sadly, that happens too often to people. You know what I mean?
That's why we have a podcast, so that we can share these mistakes with everyone else. And that's what we do in aviation. You got to learn from other people's mistakes, because you won't live long enough to make them all yourself.
Well, I'll say this, man. I am impressed that you came out the other side with still some belief that it could be done right, because oftentimes what we see is people have a bad experience, and because of that, they throw the baby out with the bathwater. And it's like, hey, because of my bad experience, or because of some people's bad experience, this is just like no good. And that's just super impressive, because it just means that you took the time to like dive into it further and understand that your experience wasn't everybody's experience, and each person gets the opportunity to be educated and understand it, and then they can make decisions for themselves. And that's really our philosophy: educate, focus on those 6 core benefits, and things usually work out pretty well.
Absolutely. All right, 6 core benefits coming up next, but you said IUL, so that's indexed universal life insurance, correct? Versus whole life. So can you break down the differences between those? Because again, very confusing topic, and people say, "Oh, you never want to use IUL," or some people say, "No, we use IUL." So what?
There's a raging debate.
So let's settle it.
Okay.
Give us the background on both.
I'm actually glad that you mentioned this.
Best way that you can explain this.
So here's the deal, Tate. So we're actually doing like a 3 or 4, I don't know how long it's going to be. It could be like 5 hours when we're done with it, right? But we're doing like a 3 or 4 podcast YouTube series on all things life insurance. And so we've been getting into these exact conversations. One, because it's really interesting that the debate is as strong as it is. And it's generally from within the industry, right? The whole life crowd thinks that the IUL crowd's a mess, and the IUL crowd thinks that whole life is like dinosaur and you should be using only. And the reality is, like, if you pull back the curtains and understand the dynamics of how they work, they both absolutely have a place. So Index Universal Life is built different and for a different, like, they don't have the exact same purpose. The thing that they have in common is that they're both cash value life insurance that are supposed to create a death benefit for the duration of our life. The big difference comes in how they get credited interest. Whole life policies get credited by dividend and interest. There's a guaranteed interest rate, and then these really great mutual companies that have been around for a couple 100+ years, they've just done a really good job of delivering consistent dividends. So like you can go in and expect, if it's designed correctly, and correctly from our perspective, designed, minimized the cost and maximized the cash, you're going to get, based on today's interest rate, a little bit over 5-ish% return based on, health and some of those things. And then you go to the Index Universal Life side, we're being credited based on a market index. Our money's not actually invested in the market, but that's how the crediting is actually happening. It'll usually be like the S&P 500. There might be a year look back. They'd say, okay, how did the S&P 500 do? And they would then, I shouldn't say at that point. What they've done initially is they create a floor and a cap so that your money can't go below a certain amount and it's not going to go above it, right? So the idea is to try to capture some of the gains without taking all of the risk of the downside, like I have in another type of life insurance, variable universal life, which is totally market-based. But again, like there's a bunch of nuanced differences that we could get into. And yet, like, I really think the message that I would tell people is just that there's not one that's necessarily better or worse than the others. They just have different uses. And our goal is to take the value proposition that they provide and match it with an individual's goal to create whatever generational wealth is, the kind of like everybody's goal. And so using those as tools is really the key. Instead of having like, to me, it's crazy to have these like really strong opinions about one or the other, because if you pull back the curtains, they really both create significant value. They just come with different risks and variations in how they, credit cash value.
Okay, that's great. So let me pose a scenario for you. Airline pilot, 40 years old, makes $400,000 a year. The goal is to invest in syndication deals. What do I want?
we would use whole life insurance in that situation. So when it gets back to one of the ways we really easily delineate is based on the strategy. So the investment optimizer strategy, which Rod kind of talked about, where we're basically just flowing money through a policy to create an additional layer to create more return, right? In that situation, we like whole life because it's not correlated to the market. We don't have to worry about any of the, even though an IUL has different ups and downs. Well, I'll give you another example. In an index universal life policy, it has surrender charges, which might hamper your ability to get to the money. And so again, if that's a long-term play, I might be okay with having a little bit of a runway. If that's to bring cash out to invest, for us, it's almost always whole life insurance that we use in that situation.
That's the best explanation I think I've ever heard. So thank you for that.
Thank you. That is very nice of you to say.
All right, let's get to these 6 core benefits.
Okay, I'll kick us off. So I love talking about leverage because I genuinely believe it's the most powerful wealth building principle or tool that's available to us as people.
Couldn't agree more.
Man, we're on the same page, Tate. I'm loving it. The other thing I'll say is that it does have to be used with care. And so whenever I bring out leverage as this powerful tool, it's also what helped or what created a lot of bankruptcies in 2008, right? So what we use is the phrase conservative leverage, and that's really the philosophy that we have around leverage. But using it to our benefit, I should say this, not using it to our benefit is massively, will basically hamper us in a massive way. Whereas, again, going back to one of the differences from our experience and really successful investors is when we were younger, and what we see in our clients today is that they are actively using leverage to create, a better, oftentimes risk-adjusted return through things like syndications, like you gave an example of.
Let me just jump in there real quick. If anybody, I think that the vast majority of our audience probably knows what we're talking about when we say leverage, but if you don't, it's debt. And I always say, hey, debt is a tool and it's a powerful tool. But if you don't know how to use it, better not to do it, right? So this is why Dave Ramsey says, pay down all your debts. And of course, credit card debt, if you got credit card debt, pay it off because that's high interest.
Sure.
But I hear people all the time that say, I'm so excited. I'm almost done paying off my house. And I'm like, what's your interest rate? They're like 3.25%. I'm like, what are you doing?
Like, no, don't do it.
Don't do that. Because if you think you can make 4% somewhere else? Well, if the answer is yes, then you're gonna do better by investing that money at 4% and paying interest at 3.25, and that's called interest arbitrage. But real quick, the example that I always use is, if you don't know how to drive a car, then you probably shouldn't get behind the wheel. And then I think this came from Brandon Turner or David Green, right? And I love this.
Yeah.
But if you know how to drive, it's kind of silly to walk for a day and a half when you can drive in 20 minutes, right? So it's responsible use of debt and educated use of debt.
Yeah, we're totally philosophically in agreement on that. Rod, I'll let you talk. Maybe you can talk about the velocity and cash flow.
Sure. So velocity, the way we would define velocity is just getting the money that you have invested back in your hands as quickly as possible, right? So that you can then go back out and invest it again somewhere else. And it sounds like a really basic concept, and I think it is, but we include as one of our 6 core benefits because we have to build our investing processes and schedules so that we always keep that in mind. And then when that money is coming back to us, that we're doing something with it, or we're getting it back out working for us again. And this, again, going back to the investment optimizer, that's one of the core benefits that we talked about there is in between deals. In other words, let's say I take a $100,000 loan against my policy, I go out and invest it, and that creates whatever, $5,000 a year of income or a month of income, whatever it is. I'm going to flow that all back into the policy because that's a place where I have value that I can add to that while I'm between deals. Again, the savings account, 0.1%, the investment optimizer, 5% plus, that's tax-free, 7, 8, 9% taxable equivalent. And so it's working for me between the deals because I can't take whatever $2,000 at a time and go invest in a new syndication every time, right? I have to sock it somewhere, build that up and do that. And so it's just making that process more efficient.
I call them $50,000 bullets.
Yeah,
you got to get a bullet in the chamber and then deploy it.
Yep. Yeah, but it takes time.
It does. Yeah.
So that's velocity. And then the third core benefit is cash flow. And I'll go back to our friend Robert Kiyosaki. And one of the basic premises that he teaches is we want to get to a place where we can create enough passive income to replace our active working income.
Yes.
And the quicker we can do that, or the more efficient we can be in doing that, the better off we are. And it's all about cash flow. And so the kinds of strategies, the kinds of ways that people invest in the alternative space, in a lot of cases, they're already of this mindset, right? Or they get some of the core principles we're adding to the kind of knowledge base that they start with. But creating cash flow and the timing and the consistency and the duplication. In other words, if I need $100,000 of passive income to replace my working income, then I probably am not. I can't call myself there if I have 100,000 because I need to have some duplication, right? Because as you know, if you have rental income, sometimes the renters move out. Sometimes you need to remodel the police, right? So we need to have be smart in the way that we are setting this up, but again, staying focused on that cash flow.
Okay, what's next?
So maybe I'll just go into the next one, tax. And really, like, cash flow philosophy is so different from this accumulation-based philosophy that most of us have grown up in and been fed for so long. So
let's talk about that. Yeah.
Yeah,
because that's a big shift in mindset, and that's one of the best in my mind. That this is one of the light bulb moments is when you switch from thinking, okay, how much money do I need in my retirement account to retire, to how much cash flow do I need that is never going to end. You buy real estate and it's just an infinite stream of cash flow that goes on in perpetuity, and then you get to pass the underlying asset down to your heirs. That's generational wealth. That's how the wealthy do it. So yeah, let's talk about that.
Yeah, well, I'll say this, again, seeing the difference between those two models, and again, seeing people at 70, 80 years old and net worth differences is pretty remarkable. Because if you think about it, not only am I creating the cash flow, I'm also continuing to build the assets. So it's I don't get to a place where I suddenly start spending money down. Normally, I'm pulling my cash flow off, but oftentimes the asset is continuing to grow, right? So it's just, again, it's this total difference in philosophy. And to your point, it gives you the opportunity to create generational wealth. You think about things that pass on to the next generation. Well, one of the most powerful vehicles for that is real estate. Real estate receives a step up in basis. So when I die and I give that to my children, right, they get it at that value, right? That's incredible. So a huge value proposition is just being able to do that. But to your point, it does take a little bit of a shift. And my experience, I would say our experience, is that it generally comes with education, a desire to learn and build. What happens is as people are trying to figure out a better way, they oftentimes stumble across something like Robert Kiyosaki's book, which has changed, tens of millions, maybe more than hundreds of millions of lives, whatever it is. One of those moments usually has to happen, and then they can let that in, and suddenly this becomes a completely new way of thinking. And what usually happens is they usually go all in, right? And when I say all in, I just mean philosophically all in. That doesn't mean that we're, irresponsibly shifting money from, my stock market based accounts to real estate. But what we do see frequently is that people kind of get the bug and they see the value proposition that they can create in the alternative space. And then it's just a matter of, well, how do I effectively get money from one place to the next? So anyway, I kind of got off on a tangent there, but that's my feeling on that one.
Yeah, that's excellent, Christian. So what's next? What's the next core benefit?
Okay, so we talked about cash flow. tax optimization is the next core benefit, and it's critical because it's literally our biggest expense. Again, our clientele is almost exclusively high income earners. And so they're, without question, without fail, their biggest expense is going to be tax. And so the question is, what can we do to minimize the amount of tax we're paying and optimize the amount of cash flow we get back? Well, in a pilot situation, like, it can be a little bit difficult because most pilots are W-2 from my experience. Is that fair to say, Tait?
Yep.
Okay, so
Yep.
So if that's the case, I don't naturally have like this business owner element. However, what's really fun and interesting is that once I kind of get the feel of this alternative space and I start investing that way, one, I automatically create tax benefits. It's important that I'm working with the right people, so I'm taking advantage of those. But number two, I'm creating a business or at least I have the opportunity to turn my real estate investing into a business, which then allows me to create a lot of the tax benefits that I can get as a business owner. So tax optimization is a really critical one. And again, most people just kind of assume there's not much that we can do, when in reality, there's a lot we could do to make that money come more to us, less to the IRS, more to our family.
Love it.
Okay, Rod, why don't you talk about asset protection?
Yeah. Let's hop into asset protection.
Awesome. Next core benefit is asset protection. And I mean, the key on this one is that we're building our wealth. We don't want to lose it, right?
Right.
And as high income earners, we have a big target on our backs, right? Whether we like it or not, in ways that we may not even anticipate, right? So we carry insurance, right? When I'm driving a car, I have my insurance, but that doesn't mean someone can't sue me, right?
Right.
And so what we're focusing on here in this asset protection vein is that I'm building my wealth, but I need to do it. I need to build structure around it in ways to keep it isolated, keep it out of reach for people in a lawsuit or a creditor type of situation. So for example, when I'm buying a piece of property, I'm going to do that inside of an LLC, right? That's a really basic example. I think a lot of people understand. But I also want to build around, we can use trusts, we could use insurance, right? So in addition to my regular car insurance, liability insurance, if I have like an umbrella policy, what that does is it increases the limits of the coverage for a very little cost, so that if I am in that car accident and I cause whatever, my limit is $500,000, but I cause $1 million worth of damage or medical expenses or things like that, then I have this additional coverage that kicks in. So these are just a few examples, but the types of things that are critical for serious wealth builders to build into so that they have that protection.
Okay, so as we've kind of talked through this list, like, we start with the core wealth building principles, and as we kind of have gone on, now we're getting into optimization, and then finally we want to focus on maximization. The last core benefit is estate maximization, and it's just kind of a gradual and natural progression, especially for high income earners, to get into this place where first they're focused on building wealth, optimizing wealth, and then they want to make sure that their wealth that they've spent their lifetime building goes to the people that they care about or the places that they want it to go. And so from that standpoint, again, going through those 6 core benefits, we basically end with that to kind of put a bow on it and make sure that regardless of what place a person's at in their life, we're covering it by trying to do the 6 core benefits. And I should say this, ideally, we get to the point where we're doing all of them simultaneously. And that's kind of the optimal place to be.
That's excellent. Okay, so how, with a typical client, how do you roll all those things into one? Like, what does that look like?
Rod, I think you should give an example of using an ATM fund just to kind of give a natural flow of clients that we typically work with.
Yeah, great. So when we meet up with people, sometimes they are already in the flow. They're already investing alternative assets. Sometimes they're at the front of their journey or maybe somewhere in between. But maybe one really good example is it's an ATM fund. And maybe some people are familiar with that. For me, when I first heard about it, I was like, really? Like, you can invest in ATM machines? But the fact is that you can't, like, somebody owns those, right? Somebody's profiting off of the fees and maybe advertising space there. And so you can invest in a fund like this. And when you look at the pro forma, but basically what it builds is like this, is that you put in your initial investment, and then it creates a cash flow, a monthly cash flow that's coming off of that over the next 7 years. It's a little bit different than what we normally think of because you don't have an asset at the end.
Right. There's no sale. There's no return of principal at the end. So it's a high cash flow for 7 years.
Exactly. But it's great for the cash flow. And there are tax benefits that can come with it, et cetera. Well, when you look at the pro forma, at least the one that we've invested in, it shows a 16.5% IRR over those 7 years off of the dollars that you put in, okay? When you invest with benefits and you include some of these other pieces, so for example, by having the investment optimizer and as your opportunity fund, you're taking them funds out of there to go out and make that investment, flowing it back. What happens is you turn that 16.5% return into 20.8. So immediately you have a higher return by the way that you're flowing that. And then secondly, when you optimize for taxes, especially with bonus depreciation, then you turn that 16.5 into 30.7, and then you add the investment optimizer, it turns it into a 37% return. And now you have something that is, again, you mentioned the word earlier, like generationally different, because if I can have, and I'm not saying I'm getting this return on all my investments, let's just say I could turn a 16% return into a 37% return on a regular basis, then that just changes by multiples the kind of wealth that I'm going to be able to build between now and when I am passing on to the next generation.
Absolutely. Yeah, I love that.
It kind of sounds exorbitant, right? Like the returns, that sounds like a huge difference. But again, it's just, if we're laser focused on those 6 benefits, and in this case, tax optimization ends up being a huge piece of it, right? Being able to take like the bonus depreciation changes the dynamic of what an investment is. Again, that's why we believe so much in utilizing alternative investments where it makes sense.
That's great. I mean, this is why on this show we focus so much on real estate, is because of the tax benefits associated with it. You know, if you look at a stock or a mutual fund, right, that is going to return 8%, it wouldn't, right? But let's say this makes 8%, or I can invest in a real estate deal that makes 8%. Real estate deal is going to win all day, every day, because the tax benefits associated with it. Plus, you can use leverage,
right?
Plus, there's the amortization. Plus, it's just, it goes on and on. So we're definitely aligned on that. We're running short on time. I want to talk quickly about the know your number, because that's not something that I think we've broached on this show yet. And I think it's important, instead of accumulation-based know your number, a cash flow know your number. A lot of people, I think, haven't really taken the time to think, okay, what would it take for me to be able to retire tomorrow? How much passive income would I need every month in order to just, walk away or fly for fun at that point, right? Can you sort of talk about how someone can go about finding that number, and then how to reverse engineer your path to it?
Yeah. So to begin with, let's contrast again. I know we talked a little bit about the comparison, but when you're trying to know your number on the accumulation side, there are a bunch of variables that you have to solve for. What's my return going to be? What's inflation going to be? What kind of medical expenses might I have, et cetera, right? And in the face of that, the traditional advisor comes out and says, oh, well, we just need to get to a place where you take this 4% or 3% or whatever. They're going to pick a number and say that's what you get to live off of with increases in the future. And they'll run simulations and they'll say, okay, based on that and how old you are now and how long we think you're going to live, then you have a 78% chance of succeeding in that situation. Well, each of those variables, it's a challenge to try to solve for it because we have no idea what they're going to be. And I'll take inflation as an easy example because it's something we've dealt with, especially recently. And when you compare the accumulation, the know your number person against the cash flow know your number, well, guess what? When inflation was going up and you had rental income coming in, you're getting a lot more income as a result of the inflation than you were before, right? So again, I'm not saying that it's not a variable we have to think about, but when you're on that cash flow side, it's a variable that in most cases just solves for itself.
Right. That's a great point.
Can I just rant about this whole, like, it's amazing, Tate, that we still see people talking about the 4% rule. I know that you've heard about, everybody's heard about it. If you're Dave Ramsey, it's actually the 8% rule. But to Rod's point, like, you know, if you're using the 4% rule, which just means that I'm pulling 4% of my retirement assets out, using that to live off, right? And then basically using Monte Carlo simulations to determine, you know, what that looks like. To Rod's point, like the fact that there's a 20% or 30 or 40% chance of running out of money, to me, it's just absolutely insane. And if, by the way, if you're using Dave Ramsey going 8%, there's like a 50% chance of running out of money. It's just absolutely insanity. And we've been watching this kind of framework fail for years and years and years, and yet it keeps being spewed out. It just, to me, is crazy. So I just had to take a second and give you my thoughts on that. That's my rant. Rod, sorry about that.
Yeah, no worries. That's great. Okay, so I focused on inflation because when we're when we're saying, okay, well, what's your number, right? How much income, how much cash flow do I need to be able to create to live off of and expect that, you know, for the rest of my life, I'm going to be okay. And because I don't have to necessarily think about the inflation piece, it makes a huge difference because I can build it based on where I am today and grow that as I go.
Right. And just to make sure everybody's tracking, what Rod's saying is that, you know, if inflation goes up by 10%, well, then rents are going to go up by 10%. And so it solves for itself. It's a self-balancing scale.
Exactly. So I can go say, based on my current expenses or what expenses I would have in a retirement setting, now I can build off of that. And I kind of hinted toward this earlier. If my expenses are $100,000, then $100,000 of passive income probably isn't going to be enough.
Right.
Because now you might say, well, mathematically it is. And yeah, okay, great, they line up. But I also have to build in kind of the risk factor, because can rents go down like in a deflationary or at least stay flat for a while? Yeah. Do I have periods of time when I'm not getting 100% income off of that because some of my units are not being lived in right now? Yes. Do I have times where I may need to sell a property and buy another one, and so I have some downtime during that? Yes. So all of these things happen. So I need to build in a kind of fudge factor. And again, it's going to differ from person to person. But I would say, as we've had this conversation with a lot of people, then a comfortable place is maybe like 150% of whatever your anticipated expenses are. You want to have 150% of that in cash flow coming in. And we've seen people that go as high as 200% or more. And what's funny is kind of this whole theme of the conversation. Once you get on that track and then you're building it, I don't want to say it's easy, but it happens without you having to think about it, that number keeps getting bigger.
Right.
Especially while you're still working and you're rolling that into new investments and creating kind of the snowball effect of growing that income. So it might seem crazy to go from 100% to 200%, but once you can get to the 100% level.
Yeah. I'm a living, breathing example of that because, you know, I'm on this path and I'm building my passive cash flow, but I'm not stopping working. I still have an amazing W-2 that's coming in. And so, you know, if you get to $50,000 a year, it's not like you're taking a pay cut in your W-2. That's an additional $50,000 that's coming in every year. And now you get to $100K and that's on top of your W-2. You get to $200K and that's on top of your W-2. And so it just accelerates on itself. It's wonderful. Well, guys, I want to be respectful of your time. One of the things that really stood out to me was this 4 or 5 hour podcast or masterclass or whatever you have on whole life versus IUL. How do people get access to that? And then how do people find out more about Money Insights and yourselves?
For sure. So go to investwithbenefits.com. Again, investwithbenefits.com. And we'll have some webinars up on there that you can check out already. But in addition, if you give us your information, we will give you a copy of our virtual summit we did last year. I guess it's been about 6 months ago. We had Sharon Lechter, Tom Wheelwright, Ken McElroy, really like powerhouse, good speaker group. Again, go to investwithbenefits.com. You can also check out the Money Insights podcast or go to moneyinsightsgroup.com. All ways that you can connect with us. But can I just say, Tate, this has been awesome. Your podcast is amazing. And it's been, a blast to hang out and talk with you.
Thanks, Christian. This has been excellent. I think people are going to get a lot out of this. So thank you. All right, gentlemen. Well, thank you again for coming on. Reach out to Christian or Rod if you'd like to connect further. For now, we'll see you next time.